Thanks for joining us today on Market Call. I'm Morello Fernandez. Martin Cobb on the show with us today, Vice President Equities at Lorne Steinberg Wealth Management. He'll take your questions on global and North American equities. Here's how to reach us. 1-855-326-6266. You can also email your questions in marketcall@bnnbloomberg.ca. Martin, good to see you. Thanks for coming in. Thanks for making it in the aftermath of the snowstorm. You talk about the January barometer. Where is it to date?
Yeah, I was having a bit of fun. The January barometer, I think it was derived in the 1970s by a chap called Hirsch, who used to do the Stock Traders Almanac. And basically what it says is how January goes, so will the rest of the year. Now, if January is positive, it has basically an indication saying that you've got a 75% chance that the market will be up. But you've got a 75% chance the market will be up anyway. However, if January's poor, it tends to be a better indicator. It's more of a 50-50 coin toss. We're sitting here today, I think last I looked, the S&P 500 is up 2% in January year to date. So it should be a good year for markets, therefore, if you believe in the January.
But it's also a midterm year for the elections in the U.S. So how does that change the odds of making money?
Yeah, it's a great, if you just go back and mine data, and I tend to mine data to come up with, meaningless sort of arguments, and this is another one. So take it with a big pinch of salt. But interestingly, if you look at the presidential years, and you just look at the performance of the stock market, the midterms year, the second year of the presidential cycle, is by far the worst. The S&P is giving you something like a 10, 11% return over time. In a midterms year, again, going back over the last 100 years, it's more like 5%, by far the worst. And it's a 50-50 coin toss again on whether or not markets will actually be up in a midterms year. There's a narrative that goes with it, in terms of, because of, political uncertainty, et cetera. I don't know. We human beings love our narratives. But typically, again, just looking back in history, this is not a great year to be an investor in the stock market compared to others. Okay.
We've seen broadening out beginning in the second half of last year. Are there sectors that you are picking away at in the broadening out part of the market?
Yeah, you've definitely seen that. We saw it at the tail end of last year. And if you look at this year, if you just look at, the Mag 7 underperforming the S&P 500, which is underperforming the equal-weighted S&P 500, which is underperforming small caps. It's the mirror image of what we've seen for the last couple of years. And and I think it's a great, healthy kind of rotation into other sectors. I look around the world, look in our backyard here in Canada, and one area I find particularly interesting is high-quality industrial. So high-quality businesses that are not exposed to AI or technology. They may be users of that ultimately in time, but seem a little bit forgotten about. So there's opportunities there. But say within a global universe of 10,000 stocks or so, there's always something that's a little bit neglected.
But why industrials? What piques your interest in industrials per se?
I'm always looking for high-quality businesses. I will go down the quality scale to some extent if valuations are so compelling. But if I can find a business that it has a strong economic moat, market leadership in an area that it continues to dominate, the valuations, though, in that area have just come down somewhat because no one's really talking about them. They're talking about AI and technology. They're talking about defensives, consumer, healthcare. It's that middle ground of apathy, which you've heard me talk about before, sometimes just leads to some great opportunities to buy great businesses, maybe a little bit more cyclical, but ultimately long-term compounders over time.
Might be a good shot for this year with the barometer where it is. All right, let's take a quick break. Martin Cobb joining us, Lorne Steinberg Wealth Management. Again, he's taking your questions on global and North American equities today. Here is the number to reach us. We're back in a moment. Welcome back to Market Call. Let's go to an email from Brian. He has a question today for Martin. He says, I'm considering adding Keyera into my portfolio. What are Martin's views on the company? This is an energy company, oil and gas, I guess, out of Alberta. What do you like or not like about them, or what do you have to say?
Yeah, Keyera, what do they do? Well, they're a pipeline and a processing company in natural gas and natural gas liquids. So the kind of the propane, the butane, in addition to the ethane and methane that comes out of the ground. And they are, unlike a Keystone pipeline, which goes from A to B, they have a huge gathering footprint in the Western Canada sedimentary basin. And they do a lot of processing and storage. So they're well positioned. They're doing a large deal, buying planes, which will give them more pipeline business, taking on quite a bit of debt to do it. So I kind of like the stability of the cash flows. We own TC Energy because of that stability of the cash flows. They get paid through thick or thin. The problem I have with Keyera is simply over-distributing. Yes, they have a nice 5% dividend yield, but they're not funding that out of cash flow, out of free cash flow. And that concerns me to some extent. They're having to issue shares. There'll be more shares coming with this deal. So whilst I like dividends to some extent, I like to have dividends well covered, the ability to grow dividends over time. That's much more important than paying a high yield, which is a sign of, of over-distribution at times. So not a bad place to be. I prefer something like TC Energy, which went through a deleveraging process 3 or 4 years ago, is now better positioned to grow its dividend over the longer term. But Keyera, you could do worse than Keyera in your portfolio.
Okay, let's move on to our first phone call then. Sam's on the line. He's in Kingston, Ontario. Hi, Sam.
Yeah, good morning. I'm calling with regards to Viatris. Lorne had earlier recommended a couple of years ago and wanted to take your take on this. And also, please, if you can provide analyst estimates or following. Thank you.
Okay, thank you for the question. So, a pharmaceutical company.
Yeah.
Do you still like it? Is it one you are invested in?
It's one we owned, but on a short leash. This is a great example. Basically, it was formed through the Upjohn business of Pfizer coming together with Mylan. They put the two businesses together. It has a suite of generic drugs like Viagra, Xanax, etc., and then some kind of growth areas like eye care, but really very little growth. So your average pharma analyst doesn't like it because they like to talk about the next Ozempic. So this does not fit that bill. It throws off cash flow. My biggest disappointment with them has been their capital allocation. If they would just stand still and eat themselves, because the valuation is a single-digit multiple of earnings, they could do very well. They sold some businesses at really nice multiples, and then bought something else at even higher multiples to try and get some sort of growth engine. And that, to me, is the difficulty I have with some CEOs who just want to have bigger companies. Let's face it, pay packets are tied to the size of the company. So there's an opportunity here for this company to really eat itself through its free cash flow and do a very good job for shareholders. But the proof is not in the pudding yet with this company in terms of being able to do that. It appears they still want to grow the company. So whilst I like the setup, if I could send them the Outsider's book, Thorndike's book about cap allocation, I would. I would say, please focus on shareholder value, investing in your shares at 7 times, 8 times earnings, much better than buying something at 20 times earnings. They could serve us very, very well. But as I say, we've seen very little evidence that they want to do that. So that gives me some pause for thought. But we still like it.
Okay. Sam wanted ratings as well, consensus rating. 5 buys. I've got 5 holds and then 2 sells. And the price target is $12.55, 12 month out, so lower from where it is today. Okay, that was for Sam. Let's go to Sophie. Sophie says, wondering your guest opinion on Netflix. Thank you very much, Sophie. And Netflix, of course, big topic of conversation because it's out to buy Warner Brothers, but is in a bidding battle.
Yes. I mean, Netflix, if there's one company I've come across that has pivoted successfully over time more than Netflix, I can't think of it. I mean, I remember my first coming across Netflix was a vending machine in Sobeys. Like, what is that? And,
They used to mail things,
Yeah,
right?
They used to mail
Back
things
then.
to you. Then
Yes.
they pivoted to streaming. Then they pivoted to their own content. Then they pivoted to sports. And then you had, obviously, 3 or 4 years ago, the whole problems with subscriber growth, the streaming wars, multiple accounts, password sharing. So they cracked down on that and then brought in an ad tier, another pivot. This is another pivot, again, you could argue, because they're looking to buy $100 billion worth of content, the Warner Brothers studios, the HBO, the great franchises. And we're kind of not sure about it. The stock, the market fell in love with the stock up at about 6 months ago. It was on 50 times earnings. It's retraced because of this bidding war. Will they get it? Won't they get it? If they get it, will they overpay for it? There's a bit more of a question mark over them. So the organic business is still growing, although it's slowing to some extent. The big question mark is what will happen to Warner Brothers in terms of their ownership or otherwise. And that gives me some, just hesitancy to recommend the stock here because we don't know if they're going to buy that business. If they do and pay a full price for it, it's not a great growth asset, great content, but not necessarily the growth engine that Netflix has enjoyed, Netflix investors have enjoyed in the past. So 30 times earnings, still a bit of a question mark. It's a fairly full multiple for the stock today.
Out of curiosity, the fact that they're now offering full cash, is that sort of also change your mind on whether it's a good deal for them?
It was predominantly cash. I think that's for the Warner Brothers shareholders. They're trying to do that. They'll have no problem in leveraging the balance sheet to some extent. The thing about the Warner Brothers assets, they're very cash generative. You've paid for that content. Yes, you have to still invest in it, but it'll chuck off a lot of cash. So they should be able to pay down the debt very quickly. So it's more for them to get over the finish line, although there's a huge political finish line they have to get over more than anything. So it doesn't really alter it all too much.
Okay, let's go back to the phone lines. And Frank is on the line. He's in Huntsville, Ontario. Hi, Frank.
Oh, hi. Thanks for taking my question. I'm looking to buy one of the either TD Bank or Royal Bank, and I was just waiting for a pullback. And I know Royal Bank has kind of pulled back about 5%, and so I don't know if this is a good buying opportunity. And again, I don't know which one to buy, given that there's a big difference between the PE ratios between Royal and TD. So if you could just tell me, one, if it's a good time to buy one of those two banks, and if it is, which one would you buy? I'll hang up and listen to your answer.
Okay, good. Interesting question. How much of a pullback would you wait for if you're going to invest in these banks? And which one would you look at today?
Yes, I always am reluctant to say wait for a pullback. All we have is today's share price. And yes, I would love to buy stocks cheaper than they are today and sell stocks more expensive than they are today, but we might not have the opportunity. We own both. We were much more favourable towards TD this time last year, just because of all the anti-money laundering nonsense that was going on.
Which took the stock price down.
Took the stock price down. The valuation, I would caution against using price to earnings for banks because earnings are very volatile with exceptionals or just loan loss provisions. I tend to look at price to book. RBC's trading over 2 times price to book. It's the best quality bank in Canada. Yes, it is, but that's a pretty full multiple. And TD's still trading on a bit of a discount, 1.7, 1.8 times forward book value. So I would have a mild preference for TD today. That being said, why limit yourself to only those two? You've got CIBC, which is our largest holding in the Canadian dividend growth strategy, or a BMO or a more beleaguered Scotiabank. So you've got rich pickings of high quality banks in Canada. So to answer the viewer's question, Frank's question, mild preference for TD, but don't rule out the others.
All right, let's take a quick break. We will line up more phone calls and emails from Martin Cobb of Lorne Steinberg Wealth Management. Again, he's taking their questions today on Global and North American Equities. Back in just a moment. Welcome back. We're going to the phone lines. John's holding. He's in Toronto. Hi, John.
Oh, hi. Thanks for taking my call. I'm just wondering your opinion on Dollarama. The price seems to be drifting off, and the earnings seem good. And I think the marketing of it seems like a price point where the middle-income people are looking to stretch their dollar, and the low-income people are always shopping there. So I'm just wondering what your opinion is. Okay. Thanks for taking my call.
Thanks, John. Any reason you see it sort of trailing down the way it is?
It's just gone up an awful lot. I mean, it's as simple as that. I love Dollarama. I go there every year on the 18th of May, my anniversary, to get my wife a nice gift.
Very nice.
And yeah, she loves that. And we own Dollarama, and we've held it since we launched the Canadian Dividend Growth Fund, back in early 2020. Today, the valuation is just fairly full. They still have some growth in Canada, but they've been expanding more internationally into Latin America, and more recently they bought a business in Australia. So we still like it. And to the point about the lower income, the affordability crisis, crisis is too strong a word. Yes, causing more foot traffic for Dollarama. But what would you pay for that? So we found with Dollarama, we still own it. We still like it over the longer term. But as cash flows have continued to come into the fund, we haven't really been adding to it. So the weighting has been drifting down to some extent. So I would like it for the long term. We have typically a minimum 5-year horizon. But just be mindful of that valuation to some extent. It was knocking on the door at 40 times earnings, a little bit below that today. It's Dollarama. It's a very well-run business with a great market position, but it's still Dollarama.
Okay. Let's go to our next caller then. Trevor's on the line. He's in Arizona today. Hi, Trevor.
Oh, hello. My question, Mr. Cobb, is on Adobe Systems. Now, this kind of brings up the artificial intelligence versus software debate. Adobe is in the software camp, and it's a very pessimistic view everybody has. Is it justified, or can they overcome this and grow like they used to before?
Okay, very good question. Adobe has been fighting that battle, as you know. What are your thoughts on Adobe?
Yeah, you asked me earlier, Mirella, about what's piquing interest today, and I mentioned high quality industrials. One or the other area that's piquing interest is software, because there's a narrative out there that AI is going to eat all software everywhere, and there's always a kernel of truth to that. And there are certainly competitive challenges to the likes of Adobe, to Salesforce, even Microsoft to some extent, from AI. I love the question there because it talked about them growing. They're still growing. Adobe is still growing at double digits. Last time it reported, double digits revenue growth and higher earnings per share growth. Still adding a massive number of new subscribers to its Creative Cloud subscription business every single quarter. And that's the area where there's a lot of threat. My wife and my daughter are both creatives, and I asked them about it in terms of what they see, because I will never use Adobe Creative Cloud, but I'm not going to cancel my subscription because I will use Sora, something free. My daughter's response is indispensable for her in her business. So there are pressures. If you look, Adobe, both on the Acrobat side, the document side, and the creative side, is embedding AI into its products. There are competitive pressures, but very simply, Adobe is still showing growth today that is commensurate with its past, but its multiple has gone from 35 times earnings to 15 times earnings. That risk reward to me is very appealing.
Okay. Adobe for Trevor. Let's move on to an email from Colleen. She says, I've owned UBS for quite a few years. Please tell me if I should continue holding and if you're expecting much upside for UBS. Go ahead.
Yeah, European banks have done exceptionally well the last couple of years. Actually, banks around the world have done quite well. And it goes back a little bit to what I was saying, the question regarding RBC and TD is the valuations are up there. I like the Credit Suisse deal. If you remember, UBS was able to buy Credit Suisse at a knockdown price as it was orchestrated by the Swiss government, and that gave them a nice kind of growth engine. I just find today, if you've held it for a number of years, you've done very well. The valuation for something like UBS is fairly full today. If your position size is quite sizable, you may want to take that back somewhat. I do think there is maybe a little bit too good news baked into some share prices in the banking sector around the world, and maybe a little bit of room for disappointment.
Okay. Let's move on to our next caller then. Jim's on the line. He's in Hamilton, Ontario. Hi, Jim.
Hello. I was specifically interested in your comments about the market generally, and I was wondering about your thoughts on AT&T specifically.
Okay, thank you for the question. I haven't talked about AT&T in a long time. Do you hold? Have you ever held AT&T?
No, and we've no plans to. I mean, it looks cheap. I mean, on just headline price earnings numbers. But this is a business that is struggling. And if I want, go back to what Warren Buffett once said. If you want to buy a stock, pretend the market's closed for 10 years. Do you want to own it? And with someone like AT&T, there might be a trade. I have no ability to trade it. But ultimately, do I want to own that business? The lack of growth, the lack of compounding, I don't want to own an AT&T. So there's so much better things you could do with your money today. We've talked about some of the stocks even in the last 20 minutes or so. So I focus on quality businesses with growth opportunities, even if the multiple is a little bit higher. Do not be attracted to a low PE, high dividends, paying stock just because it looks cheap on the optics.
Okay. Let's get to Ghulam then. Ghulam's on the line in Toronto. Hi, Ghulam.
Hi there. Good afternoon. My question is on Enbridge. I think the price has been dropping lately, and I think there's some concerns on growth, and even the stock rating has been cut to neutral. What's your view on it? Should I add to my position or go with something else like Pembina?
Okay, thank you for the question. Enbridge having around 65. Is it a hold for you? Would you take some money and put it somewhere else?
More of the latter. It's a very similar answer in some ways to Keyera. You can look at the business. Enbridge is predominantly a liquids pipeline business. And it's, again, a business like Keyera that is over-distributing. I like to see free cash flow, paying dividends, and CapEx, and a little bit left over to invest in the business. So they have a perpetual kind of creep up in the number of shares outstanding, kind of robbing Peter to pay Paul. Mm-hmm. Again, I just don't like that. I mean, if a company's paying a very high dividend and distributing an awful lot of their cash flows, they're basically telling you they have nothing to invest in. And it's hard to invest in pipelines. You can do some expansion of the existing facilities, but it's quite difficult to do so. So whilst I like pipelines, I love the barriers to entry. It's like railroads as well. I like to see individual businesses that are not over-distributing, that can invest in their business or grow their dividends, and Enbridge just doesn't fit that cap. We have owned it in the past. It's served us very well. It started on a much lower multiple. We sold it and we consolidated our ownership in the pipeline side into TC Energy, which we believe is better positioned and cheaper and more opportunity to grow its dividend.
Okay, let's move on to another caller here. Chris is in Delta, BC. Hi, Chris.
Hi, Morella, and hi, Martin. Martin, before I forget, I want to ask you if you've ever been to the Orkney Islands. And then as well, if I could ask you, that's where my family's from. I've never been there. I've been to mainland Scotland. But and I'd also love to ask you about United Health. I've been watching that one for I guess, months, even a few months before Buffett's announcement that he stepped in was publicized. And, of course, today it's now down about 20-odd%. And I'm thinking, is today the day to pull the trigger? And if you would, what sort of a weighting would this position have if it was a complete position, maybe half today, half tomorrow sort of thing, but overall in the end, what would the weighting kind of look like? Thank you so much and have a great day to both of you.
Thank you for the question. So down on a revenue decline, first one in decades.
Yeah, firstly, no, I've not been to the Orkney Islands. I like their scotch. I did get offered a summer job as a potato roger. Won't bother going there.
Okay.
I can bore you with that another time, Marilla, after maybe off call. But never been to the Orkney Islands, but would love to have gone there, and almost did for a summer job once upon a time. In terms of United Health. We own CVS, and about a third of CVS's business is the healthcare insurance business, which is almost entirely what United Health is. And we've obviously had the news today. The stock was pretty beleaguered coming into this. As you mentioned, Berkshire Hathaway were buyers of the stock. The problem with healthcare today is you want to be involved in it, but there's just so much news coming out of the administration, of this, that, the other thing, that a lot of their profitability is dictated by the whims of an individual or two, sitting somewhere, south of the border. So it is a speculative play to some extent. There's still a good business in there. We still need health benefits, health insurance, all that kind of thing. The stock is obviously, I think, about 20% cheaper today than it was yesterday. Mm-hmm. I do think this too shall pass in terms of its market position. Them and Humana and CVS's Aetna business dominate the market. If you've got a little bit more risk tolerance, which sounds maybe that he does, you could have a position in it. In terms of position size, it's hard to say without looking at your entire portfolio.
Sure.
But I wouldn't put 20% of my net worth in it, but maybe a few percent over the course of the next few days, with a 5-year horizon might serve you quite well.
Okay. Let's take another quick break. We'll have a look at Martin's past picks when we come back. Welcome back to Market Call. We're going to go through Martin's past picks from February 5th of last year, so just short of a year ago. At the time, he chose Saputo, SAP on the TSX, 2403 at that point, now 41.59, so 73% upside, a total return of 76%. I think of cheese, of course, when I think of Saputo, but what did you see last year that you liked about this company?
Cheese. No.
Lots of cheese.
Yeah. There's the Saputo branded cheese that we have up here, little red tubs, top with a red top tub. And they have the same in the UK and Australia. But the big problem with Saputo back a year ago was their US business, which is the more important business. And it's more the food service side, less branded, less retail. It was struggling to make money. Pardon the pun, the milk cheese spread was tough. South of the border. They were also investing in some of their operations, so there was a bit of an investment kind of headwind as well in terms of costs being involved there. But really, investors had just fallen out in love with it. They just assumed this was going to be, the bad times would continue forever. The valuation was down around about 12 times earnings. Okay. It's not a great growth business, but ultimately just looked far too beaten up. And, since then, the business has recovered to some extent. They're now benefiting from the fruits of the harvest of their investments. But the stock is now pretty expensive, and we're actually exiting it.
Okay. Did they just straighten out what was going on in the U.S. with their services there?
It's still early days. There is some benefit. I mean, the industry conditions have improved, and they're benefiting from that. But it's they used to make 10% operating margins in the US. They're still in the low single digits today. They might get back to 5% in time. So I don't think we're going back to the good old times. But I say the big difference is investors love stocks, they hate stocks, and that migration between the two can be very beneficial. Who would have thought you can make so much money from cheese?
Who knew? Okay, there we go. Let's get to your next pick from last February. Smith and Nephew, SNN on the New York Stock Exchange at 26.12 US, then now to 34.10 US, so 31% upside, 34% upside here. They do medical devices. And we talked about healthcare being sort of repressed last year. Nobody was looking at it.
Yeah.
What happened with this company towards the end of the year? Did you start seeing money rotate into it, or how has it benefited?
Yeah, if you think we're talking about United Health or CVS's health insurance business, the cost of their business is procedures. Fixing your hips or your knees. That's what S&N do. They're a bit like Stryker, a more familiar company here in the US. Then you have like advanced wound care products, ENT products, very fancy medical devices and equipment, etc. This is a UK domiciled company that trades on about half the multiple of Stryker, a US domiciled company, with broadly comparable growth. Stryker's a bit better business, bit higher growth, bit better market share, bit higher margins, but not that much. So it's a chance just to buy a steady Eddie, long-term secular grower, trading on a mid-teens valuation. We still like it. Actually, still one of our biggest holdings in the Global Value Equity Fund is Smith & Nephew, and we still like it today, despite the fact it's served us quite well.
Okay. Let's get to your third pick from last year, then Electronic Arts, EA on the NASDAQ. And at the time, it was 130.47 US up to 204.42. So 57% upside, both return and total return. They do software entertainment. Yep. What's going right for them?
They've been bid for. So what happened with when we bought Electronic Arts, they're a video games company. And I was piqued by the price that Microsoft paid for Activision Blizzard, which is roughly a 50-70% premium to what Electronic Arts, roughly the same revenues, was trading at. Electronic Arts is the most video utility-like of the video game companies. So it has a lot of the sports franchises, which annually kind of refresh as Lionel Messi moves from this club to that club, and you have to get the new software. They're not like a Call of Duty hit title, Rockstar Games kind of, Grand Theft Auto hit title type business. So I like the utility nature, the more predictable nature. It has been announced that there's a $208 per share all cash offer from a consortium. And it looks like the stock will depart our portfolio probably sometime in the second quarter of this year. So it was effectively a case where we thought it was an attractively valued business that someone, a private equity outfit, really decided was worth more than the market was valuing it at. Thank you very much.
Okay, thank you very much, and we'll be out of there. Let's take a quick break. More phone calls and emails from Martin Cobb of Lorne Steinberg Wealth Management when we come back. Welcome back, and thanks for joining us. Todd's on the line. He's in Niagara Falls, Ontario. He's got a question. Hi, Todd.
Hey, thanks for taking my call. My question is on Spotify. It seems to be going one direction right now, and I'm just curious on the guest opinion. Thank you very much.
Okay, I'm just wondering, Shopify, do you mean, or Spotify? Okay,
Shopify.
Thank you. Okay, because he said Spotify, and I was like, I'm not sure. Okay, so Shopify we know is volatile. Take a look at the chart. It's at 185 today. What do you think?
It's funny he says Spotify because my friend Mark joined the Shopify, 10, 15 years ago, and I was having breakfast with him, and he met. I said, Spotify? Sorry, yeah. Who are these people? Like, exactly same thing. So, yes, and there's an awful lot to like about Shopify as a business. What they facilitate in terms of a mini sort of Amazon Web Services, or sit between the retailer and the consumer. And I like the business an awful lot. I struggle to value it at anything close to the current multiple, and that's been wrong in some ways. You could argue because the growth is still there. They've had a couple of times they've gone on to try and do logistics, hasn't worked out. They've got back to their knitting. It's the second biggest company in Canada. It's hard not to ignore it. The good thing is we run a Canadian dividend growth strategy, so it doesn't pay a dividend, so we don't own it, and I don't have to worry about it too much. So a lot to like about the business, but if you just look over even the last 5 years, there have been times where, it's sold off quite significantly, really, despite the business doing nothing different. And that could happen again, and we will see something like that retracement because the valuation is high.
High last year was 179, and that was in October, and down to 185. And I'm looking at the U.S., actually. Sorry, there we go. So average is about 129. Okay. Let's move on to Mario, who's calling from Brampton, Ontario. Hi, Mario.
Hi, good afternoon. Thanks for taking my call, Marella. Martin, I would like to get your opinion on Visa and MasterCard. I'm a holder of both. For a long time, I've held them, and it's not making sense to me anymore the last few weeks. I'd like to get your opinion on where it's headed. Is it time to take some off the table, or is it an opportunity?
Okay, thank you for the question. We will pull up those charts. Would you exit out of either of these?
No. My time horizon, though, is slightly longer than the most. And when I joined Lorne at Steinberg Wealth, looking at the global equity, value funds, if there was one stock I really wanted to add into the portfolio, it would have been a Visa or a MasterCard. It's one of the highest quality, both some of the highest quality businesses in the world. They get knocked around from time to time about concerns over interchange fees or PayPal threatening them, or Plaid threatening them, or Stripe. There's all this sort of noise, and here we're talking about credit card interest rates being capped,
yes.
And there's always something. So I would say have a long-term horizon. You've done very well by owning both of those stocks. Mild preference for one of them or other, not really. I think you could own both. Be mindful again of your position size, but with a 5 to 10 year view, stop looking at the share price charts. Put these in your portfolio and forget about them.
Okay. There is your answer, clear as day. Let's move on to John in Red Deer. He's got a question today. Hi, John.
Hi there. I'm calling in regards to CP, ticker symbol CP. Obviously, that's CP Kansas City. Rather frustrating. It's been just doing its thing over the last couple of years. I'm into it for the last couple of years, but I'm thinking whether I should just get out or actually consider putting some more money into this. What are your thoughts?
Okay, thank you for the question. CP Kansas City is the rail line. You mentioned rails earlier today. You like them. Do you like this one? And would you pick up where it is today, or would you start selling?
It's another example of not focusing on the share price chart, which has been a bit soggy for the last couple of years. You talk about high quality industrials, an area around the world where I think there's some really interesting businesses. In Canada, I would put squarely in those camps, CP Rail or CPKC today, and CNR as high quality businesses, huge barriers to entry. They get buffeted around from time to time. These businesses aren't going anywhere. CPKC has quite a bit of synergy benefits from the deal still to come through, so it has a bit more earnings per share growth likely than CNR, but trades on a higher multiple. But the share price chart is just telling you that the business hasn't really changed, but they've just got cheaper over the last actually several years as investors have rotated out of them into something more sexy like a Shopify.
And this isn't tariff concerns, you think?
Well, I think it's tariff concerns today. Before it was wildfires and bad harvests, unrest from the labour market strikes, government interference. There's always something.
Okay.
But if you look at these businesses, step back and look at them from a 30,000-foot view, they grow their volumes at 3-4% a year. They get a little bit of pricing power, a little bit of efficiency gains. They're solid growers over time, not from year to year, but over time. And if you can buy them on, sort of mid to high teens multiple for CN and low 20s multiple for CPKC, again, for a 5 to 10 year view, I think you'll do very well.
Okay. John, I hope that helps you out. Let's go to another John in London, Ontario. Hi, John.
Hi, Marilla. Hello, Martin. Martin, the Mag 7 are reporting this week and next time. I'm focusing on Google today. I know you liked Google when valuation was under 20 price earnings. It's closer to 32 now. Would you add to any of the hyperscalers Google? Okay. Have a good day.
Thank you for the question. Would you?
Yeah, we still own Google or Alphabet. It's less obvious. I mean, with the benefit of hindsight, everything's really easy in this game. And this time, last spring, Alphabet was very beaten up because AI was going to eat search, and there's some truth to that. Some elements of search are definitely disappearing. They've done a great job with Gemini, having a competing product against ChatGPT. There's also a lot more to Alphabet, as you mentioned, to hyperscalers. They have the cloud business, which is growing faster than Amazon's or Microsoft's, and they have YouTube. That's phenomenal asset.
Which we often don't speak about, but does well.
Has the same revenues as Netflix. I mean, it's that big. So I like it because they've got more strings to the bow than, say, a Meta, which is exposed to advertising, which obviously the Google business is. The valuation has moved up there to some extent. We're still expecting, though, low teens earnings per share growth over the next several years. So a 30 times multiple, it's not sub 20 times anymore, is still okay. It's just not as obviously table thumping today. Interestingly, last year, the Mag 7, only 2 of them outperformed. Google,
NVIDIA was one.
NVIDIA was the other one, and Alphabet after a very poor start to the year. So maybe we see more opportunities in something like an Amazon today. I think that looks kind of interesting, more than I would say Alphabet for fresh money, but still like Alphabet, well-positioned, long-term compounder. Thank you.
Okay, let's take a quick break. We will get to more phone calls when we come back. Stay tuned. Welcome back. Thanks for joining us. Alexander's on the line in Toronto. He's got a question. Hi, Alexander.
Hi, Mariella. Good afternoon, and thank you for taking my call. Martin, question is about Telus. I have a sizable position, approximately 8% of my portfolio. Would you suggest that I hold, add more, or sell? And if it's the latter, what would you replace Telus with? Similar dividend payout, perhaps with a better growth opportunity. Thank you.
Okay, thank you for the question. They've got a high dividend, and there was discussion about, I think it's 9%. There was discussion about the dividend and what they were doing with it. But talk to me about the company itself.
Yeah, I mean, just on the side, if I could educate investors, one thing is dividend yield. Do not be attracted by a high dividend yield. The day a company pays its dividend, its share price goes down by the same amount. There's no free lunch in dividends, but it's hard, I understand it, not to get attracted to something that's paying you, such a nice income. We own Telus. We actually own Telus, BC, and Rogers, and have a marginal preference today for Rogers because of the monetization of their sports assets.
Which is what they've been pushing.
Yes,
right?
And I like what they've done with that, as long as they follow through on it. And obviously the Blue Jays doing almost the World Series kind of helped to some extent. If you look at what's really plagued all three of them, it's just been wireless pricing, particularly in Canada. There's some evidence that things are starting to settle down somewhat. The competitive kind of pressures that were forced upon the industry to some extent after the Shaw deal that Rogers did seem to be abating. Population growth would help if we had that coming back. But they're all kind of, a bit beaten up. So they're not high quality businesses. You hear me talk about high quality all the time. The dividend, I don't really care. Maybe they should just cut it. Again, I'd like to see it well covered and then they could grow it. It didn't harm BCE when they did that. So 8% though is a big position in that entity. So I would be looking to maybe trim that position size back somewhat. You could put into one of the other telcos, maybe a Rogers or a BCE. But some of the other things we've talked about today, whether it be the railroads who pay much lower dividend but much better growth prospects, or some of the other stocks we've discussed on the show.
The dividend for Telus 8.83. And just a note, of course, that BC is the parent company of this channel under the Bell Media brand. Let's go to Jacob in Toronto. He's got a question. Hi, Jacob.
Hello, good afternoon to both of you. I just want to ask about BAM, the BAM, Brookfield Management. If it's to sell or keep. That's all I have to ask. Thank you very much and have a nice afternoon.
Thank you very much. Let's look at Brookfield Management. And do you hold any of the Brookfields?
We own the Brookfield Corp, so the mothership. And the reason we own that, because a big chunk, over half of their business is Brookfield Asset Management, but they have the real estate business, private equity and some infrastructure assets. And the discount you were getting when all the fears about, particularly, office buildings, we were able to buy Brookfield Corp on a very attractive discount. This is going back, 2 or 3 years ago. Yes, they are the partner of choice through Brookfield Asset Management, the partner of choice for large, complex construction, projects. And we're talking a lot about nuclear. They're involved in that, so we like a lot of that in terms of their exposure. I don't like the opacity. I don't like the links between all the various organisations that tend to move around to some extent. I know some analysts, Viatris Research for one, question some of the valuation methodologies. So the things I don't like, but the discount was just too excessive, that you were being paid for that. Today, it's less obvious. So we've actually taken a little bit of money out of Brookfield Corp and a little bit of money out. Then we'd be taking a bit of money out of Brookfield Asset Management as a result, indirectly. So again, it's just, is it priced for perfection? Perhaps not, but it's certainly priced for the good times continuing.
Okay. Let's go to another caller then. Surinder's on the line. He's in Markham, Ontario. Hi, Surinder.
Hello, Marilla. Thank you for taking my call. My question is about open text. Stock is quite down. Is it time to put some money in?
Okay, thank you for the question. Open text, like many of the software companies we talked about and you mentioned, has drawn down here. What do you think of where it is, and would you nibble at it now?
Yeah, we own open text. The problem is they've not had a CEO for 6 months, which doesn't help. Again, it goes back a little bit to how I was commenting on Viatris. There's no growth in open text. They bought Micro Focus business, paid a pretty low price for it, spun out 40% of it at a much higher price. And so they've done well in the portfolio kind of shuffling, but there's no growth here. But they don't need it if they would just buy back their stock. Again, I hate banging the table about capital allocation, but it's so important over the long term, much more important than about operating the business. So with the new CEO hopefully coming in, why there's been no new CEO for quite some time, I do not know. would just look at the business and stop worrying about top-line growth and worrying more about shareholder returns. Eat your stock, make yourself a lot of money through your options. They could do very well. So again, it's on a short leash. Not a huge fan of the business in terms of operationally, but ultimately when your stock is so beaten up like that, there is great optionality on a capital allocation side if they follow through on it. So we would be buyers of the stock today.
Okay, interesting. All right, let's take a quick break. We will look at past picks for Martin when we come back. Stay tuned. Or new picks, when we come back. Join us tomorrow for Market Call. Ivana Dulevska will be on the show. She's founder, CIO of Spear Invest, and we'll take your questions on technology stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. And time now for new top picks from Martin. We're going to start with Constellation Software, CSU, on the TSX, a badly beaten up stock after Mr. Leonard announced he had to leave the job. But you like it. You want to pick it up here.
Yes, we are. And interestingly, we're selling Saputo, which I mentioned. A year ago, Saputo was on a third of the multiple in terms of price earnings that Constellation Software is. Today, it's on the same multiple, actually slightly higher. So we're switching our Saputo into Constellation Software. I've admired the company from afar, but never thought I'd get quite the opportunity to buy it at this sort of price. You mentioned Mark Leonard, obviously having to step down for health reasons. He's been the architect of their success. That being said, they've made 800 acquisitions since inception. There are 150 verticals, and the individual business units increasingly are responsible both for operations and capital allocation. Yes, he's instilled the culture, the metrics that they employ for acquisitions, but the acquisition engine doesn't stop. The whole AI eating software narrative is another thing that's a factor playing here. I mean, yes, I kind of get it, but you think, for example, what does Constellation Software's typical software do? Well, one is software for cemeteries. How's AI going to really, if you're running a cemetery and your software works, you're not really too worried about ChatGPT, So it's just lost. This whole narrative about AI, I think, is providing some great opportunities. And I think Constellation might well be the poster child of the opportunities that we'll look back on in several years hence. They will still continue to grow. Their average acquisition size is 17 million Canadian dollars. They made 100 last year. They'll make 100 this year. They'll continue to roll those up. They pay about 3 times EBITDA. And we're trading on a multiple we've not seen, for a decade or longer. So to me, it just ticks all the boxes. Nothing's really changed except the valuation.
Okay. Let's go to Compass Group, CPG, which is a company that provides food, services. What do you like about Compass?
Market leader. They're one of 3 or 4 kind of leading contract catering companies. So there's them, there's Sodexo and Aramark. So if you go along to your local university canteen, or you go to a sports stadium, an offshore installation, hospitals, forward defence deployment of troops, the chances are there'll be a Compass there or a Sodexo or an Aramark providing the food. A lot of it is still in-house. So if you look at the world market, it's huge. Half of it is still companies doing it themselves, employing people directly. Compass will come in, take on your staff, and will do it much more efficiently at a lower cost and make themselves a nice, tidy margin on top of it. We were first attracted to it during the pandemic when, let's face it, half their business went to zero, as no one was going to sports stadia. They bolstered the balance sheet through a capital raising, and they've been able to take more market share because a lot of their competition has suffered through that period. So high-quality industrial, you've heard me say it before, 5, 6, 7% organic sales growth, incremental margin improvements, gives you something like 10% EPS growth, 20 times earnings, a long-term buy and forget kind of stock.
Okay, what made you interested in them right now? And I ask because I'm wondering if there's more growth for them. They seem to have a reach everywhere. Are they still sort of acquiring businesses or reaching out to new businesses?
Yeah, if you look at the market, roughly 50% would be in-house. And then Compass's market share is probably about 10%. So them, Aramark and Sodexo might have about maybe 20% of the overall market, slightly under that. So there's still a huge runway of growth, both in terms of companies outsourcing and then the mum and pop businesses selling up. So there's plenty of growth for them to be had, in addition to the strong organic story. They have something like 95% plus retention rates. Well, if your food's working, in your canteen and your staff are happy, you might tweak the menu, but you're not necessarily going to get rid of Compass. So once they're in there, it's very sticky. And I say there's that long runway of growth, as long as we continue to eat.
Which we will. Okay, let's get to your next pick, which is Amazon on the NASDAQ. We talked about the companies last year in the Mag 7 that outperformed, but you think Amazon's sort of on that list of this year outperforming?
I would say so. I would say that's in terms of marginal dollars, in terms of Mag 7 stocks. I hate that term to some extent. We own Microsoft, Alphabet, we've mentioned. We own Meta, although we've taken some money out of that one. Amazon would be probably our go-to in terms of new money today. Why do I like Amazon? Well, you've really got three businesses: North American retail, international retail, and Amazon Web Services. They're by far the leader in cloud hosting, and I like the fact they've not gone crazy. You're hearing Oracle went a bit crazy in terms of announcements, this, that, and the other thing. Amazon Web Services will continue to power ahead as a growth engine. If you look on the retail business, they used to, lose money in North American retail because they invested so much. They're now harvesting that, so the operating profit there is now rising quite nicely. They're now into profits internationally as well. There's a lot they can do. I think the whole robotics automation, they'll be a prime beneficiary of that. And then you have Prime, and the advertising business. So there's just lots of strings to this particular bow. 30 times earnings, something like maybe 15% earnings per share growth. It's Amazon, formidable market positions, optionality in a number of different areas like robotics, etc. A lot to like about Amazon today.
Okay, very quickly, because you mentioned the retail business, do they still have growth there? Are they expanding that side of the business as well?
Yeah, there is growth. I mean, more growth internationally to some extent, although it was kind of loss-making because they were investing in it. So if you remember, go back a couple of years ago, they overinvested, both in terms of physical infrastructure and staff. So they've had to dial back the growth to some extent. It's very competitive. I mean, Walmart's done a great job at both being physical and e-commerce, so they're having to compete with them. But they're still a go-to. The whole Prime, cementing of the customer, the sports businesses, they kind of package into that. They just keep cementing into it. I used to use Apple, iTunes, and TV all the time. Now it's Prime or Netflix, so they're well positioned there. So there is growth. It's slowing to some extent, but underneath it, the margins are improving as that growth is slow because they're investing less.
Got it. All right, Martin, got to leave it there. Thank you very much for coming in.
Thanks, Marla. Always a pleasure to be here.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.